Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. And thank you for allowing us to do work that we find meaningful. Thank you for giving us the most valuable commodity you have, your attention. We promise to do our very best to give you a return on it. Today we have our resident commodities guru, Rick Rule, former CEO of Sprott, founder of Rule Investment Media and the Rule Classroom, co-founder of Battle Bank. Rick, thank you for coming back on the show.
Steve, it's always a pleasure. I'm a fan.
I'm a fan of you as well. Okay, I want to give a shout out real quick to the Rule Classroom. Just had a subscriber recently come over, Connor, and he said he was pleasantly surprised to find out that it was free. Go ahead and give our listeners a quick rundown of what they can expect if they come over to the Rule Classroom.
Well, the first thing is, as an inducement to come to the Rule Classroom, if you go to ruleinvestmentmedia.com, I will rank your natural resource stocks 1 to 10, 1 being best, 10 being worst. No charge for that, no obligation. That's your introduction to the Rule Classroom. The Rule Classroom is an educational entity. It is meant to teach people how to be better natural resource investors, and in fact, how to be better investors generally. We have about 13 hours of focused curriculum on various aspects of natural resource investing. And we have a couple hundred hours of more general natural resource programming. In addition, the Rule Classroom has, if my memory serves me right, about 5,500 students. And there is an active discussion group or group of discussion groups at the Rule Classroom. The idea that all of the knowledge at the classroom should emanate from the dais out to the assembly is stupid. There's 5,500 hardworking people that hang out and talk to each other there. Almost every week, although not every week, on Thursdays, we have a question and answer session that lasts for an hour. Generally, that is Albert Liu on behalf of the audience questioning me. Sometimes it's my friend Steve Barton filling in for Albert Liu questioning me. But we'll talk about really any topic under the sun that relates to natural resource and precious metals investing. Once again, the Rule Classroom is absolutely free. Our hope is that the community that benefits from the education offered up for free at the Rule Classroom becomes customers of our boot camps. Our boot camps are 8-hour long deep dives, not for tourists, deep dives into various topics around natural resource investing. We've done silver, we've done uranium, we've done rare earths, battery metals. We've done royalty and streaming. We just did private placements. These boot camps are not for tourists. They're for people who are really willing to invest their time and attention in the effort to become better natural resource investors. And then finally, the Rule Classroom's granddaddy project is the Natural Resource Investment Symposium in Boca Raton. You are best able to profit from that conference by learning the educational lessons that are taught for free in the Rule Classroom. This is meant to be a positive feedback loop. You will meet wonderful movers and shakers from the business. You'll meet exhibitors who are owned in our own accounts, and you'll have the opportunity to apply the skills that you learn at the Rule Classroom live in the symposium, which, if you do the work, will benefit your investment portfolio.
Yeah, it really has become kind of a community think tank. You know, I'll post something and then just get a whole bunch of comments on it. I got a book recommendation recently that I'm going to talk about here in a bit. Yeah, I love the Rule Classroom. And then for more serious investors, we have the Rule Classroom Plus, and that is it's almost free. It's $30 a month, but we do even more Q&A sessions with you. We have special presentations from Joe Mazumdar to Joel Littman. It's very valuable.
Yep, very good. I need to say one other thing. We have a product and organization that, if the lawyers let us do it, is going to be invaluable. Those people who are familiar with the TV show Shark Tank have a preview of what we want to do. Many customers, or not customers, Steve, I'm sorry, issuers come to me. They say, you know, my company is selling for less than half what it's worth. I need to expose myself to a wider audience. So I want to say, really, you think you can prove that? we want to develop a program where an issuer comes on and they give their presentation for 20 minutes or 30 minutes, whatever it is. And then I assemble a panel of experts led by myself, 3 or 4 people, and we poke through their story in real time, the same way we would in a boardroom if they were trying to sell us their stock. Not hostile, not friendly, factual. I've had a lot of fun with the investing process over my life, Steve, and I want to share the interest, the tension, the drama that goes on in real-time due diligence with a live audience drawn from the Rule classroom. Importantly, after the panel has had a chance at the issuer for an hour, we'd like to turn it over to the students from the Rule classroom to ask their questions, to employ the valuation lessons that they learned at the Rule classroom. So this would be a 2.5-hour session. Now, I expect for the issuer, if they're a high-quality issuer, that this will yield tremendous benefit. A very highly qualified, very involved, very high net worth, very influential audience introduced to them. If, however, they're unsuccessful, they may never be able to raise money again. The tension, that juxtaposition, I think would make a wonderful educational product that will be offered through the Rule classroom.
Yeah, we got a taste of that with Magna Mining and Jason Jessup. And it looks like you have them up on the schedule here coming up this week.
Yeah, Steve, we're going to do 2 or 3 more of these Shark Tank Light, which is what we did with Jason. I thought he did a great job acquitting himself. And there's a couple more people that we have lined up. I want to do this low test a couple times till we get our feet under us and we really know that we can do it. I don't want to charge for it until I'm confident that we can turn out a product worth charging for. But I really, really, really want to do this over time.
Awesome. Well, I look forward to it. At Rule Classroom, there is a link in the pinned comment below. We hope to see you there. Okay, some upcoming news we've got. Tomorrow, September 18th, the Federal Reserve will be cutting interest rates. The Vegas odds right now have them cutting 50 basis points as opposed to 25. We've talked about this before, that essentially it's 12 guys sitting in a room deciding what money should cost for 8 billion people on the planet. What's your macro view of this right now as we approach this meeting?
Well, if you ask me my macro view, it's a sideshow. My micro view is that the interest rate cut may be already factored into the equities market and the gold market. This has been no mystery. They've been jawboning the outcome for about 6 weeks. Anybody who doesn't know is living in a cave. My macro view is that interest rates are already artificially low. What I would prefer is that the Fed disband and they let the market set interest rates. I seem to be a minority of one with regards to that. But I do think that Fed policy in the near term is important. In the longer term, despite the wishes of the majority, the Fed is not as big as the market. And what the Fed has to overcome is $35 trillion in recourse debt and $100 trillion in the net present value of unfunded liabilities. These numbers are both growing. So irrespective of what the Fed does, they're under a lot of pressure. If they cut interest rates too far, they won't be able to sell bonds. If they can't sell bonds, they have to print and eat the bonds. I suspect in either case, you see a more rapid deterioration in the purchasing power of the US dollar. I'm not happy to say this. And by the way, relative to other currencies, my friend Doug Casey used to say the US dollar is the worst currency in the world, with the sole exception of all the others. But I think that you need to put the Fed policy in context. I think over time, the markets are bigger than the Fed. And what investors need to look at is that spread. How does the Fed overcome $135 trillion in obligations that are growing fairly rapidly? That's a really important question. It's not that the answer is obvious, like, will the Fed cut interest rates? That's obvious. But it's a much more valuable consideration.
Okay, I recently did an episode where I'm going to share my screen here and pull up. Okay, so the way we read this here is this pink line right here is the Fed funds rate.
Yep.
And this purple line here is their balance sheet. So when we see it just skyrocket like it did here, this is
Yep.
what we call QE because everyone knows what that is, right?
Yep.
Just printing money.
Yep.
And then this bar chart here is the spot price of gold. So going back to the 1989 rate cut cycle, gold actually lost 15%. Then we go to the 2000 dot-com bubble, gold gained 30. 2007 great financial crisis, gold gained 23% during that cycle. And now we can see they invented QE, and gold shot up exponentially after that. Here's 2019, gold gained 16%. And where my question comes in is if we bring up some of the gold stocks, I just brought up the Huey just because it's got a longer, track record. And if we go back to 2000 here, the Huey gained 300% in the time that they were cutting rates. And then after they were done cutting rates, it just bumped up another 71%. Now, this is where it gets interesting, is in 2000, they start cutting rates. And this yellow number here is how much the Huey initially gained. And then I don't think it's necessarily that because the Fed was cutting rates here, it dropped 70% in the middle term of it. I think it's more that the economy was in the toilet and anything that had a bid, including gold stocks, got sold. But I'm wondering if there's kind of a moment here where we're about to cut rates, and I wonder if we're going to have a run up like we did here, then a sell off, and then another monumental run up like here we had 330%. And if we go here to 2019, something similar, ran up 35, dropped 44, and then had a monumental run of 160. Do you have any thoughts on this?
Yeah. I mean, I think that we're going to have a sustained move in the gold price. And it isn't all going to be up. It's going to be up and down and up and down and up and down and up and down and up and down. But we're going to have higher highs and higher lows. And I think the consequence of the fact that the outlook for gold among generalist investors improves, that the outlook for gold equities will improve. I think, too, that higher gold prices will, for the efficient producers, lead to higher margins and higher stock valuations. You'll notice that one precipitous decline coincided with the 2008 global financial crisis, where, as you rightly pointed out, the sell decision wasn't made by investors. It was made by margin clerks, and they sold whatever had a bid. You will notice, too, that fear-based assets, including gold, came back very quickly after that rout. And I would suspect that, and I'm not saying that we're going to have a global liquidity crisis, but I would suspect that if we did, you would see gold and gold stocks sell off hard because any asset that has a bid will get sold. And I think similarly, the aftermath to that, which is fear, would be very good for gold and eventually good for gold stocks too. Well, first of all, to educate your listeners a little bit, the dichotomy in this move between the move in the gold price and the move in the gold stocks, which has been noted everywhere, is explained until 15 weeks ago by the fact that the buyer for gold was central banks, and they don't buy gold stocks. So that one's pretty easy. One sector had a bid, the other sector didn't. There was actually, until 15 weeks ago, disintermediation out of physical gold, evidenced by the gold-based ETFs. So it was pretty obvious to see that there was no participation by a community that buys gold stocks, only by a community that bought gold. I think you should see too, and we've talked about this a lot, that there are an awful lot of corporate inefficiencies in the gold mining sector. And if you buy the indexes, over time, you will go broke. You have to buy companies in the indexes. Now, the indexes are useful for capturing beta if you're a trader. And if your listeners have the same facility with charts and technical analysis that you do, and they don't overstay their welcome, the ETFs are very liquid vehicles to take advantage of the volatility. But if you're an investor, you need to take an index like the GDX and you need to buy the best 6 out of it to get the beta without the risk. And if you're in the GDXJ, you need to be much, much, much more discriminating. The bull case was made by your charts. If you look at the move in the gold equities from the top to the bottom, even if it was accompanied by volatility, and even if it took longer to occur than you thought it would, you made a ton of money just by being in the market. If you didn't buy the Kool-Aid, if you didn't forget to sell. Steve, we've seen in the uranium trade, nobody wants to be in at 20 bucks. Everybody wants to be in at 100 bucks. It's important that you reverse those instincts. It's important that you come into the markets in basing periods. It's important too that when you see the hockey stick graph that you exhibited there 4 or 5 times, that you remember to lighten up a little bit.
Yeah, yeah, trim your position.
Yep.
Another one that I'm wondering is right now I'm at about 20% cash, and looking at the massive sell-offs that can happen, I'm questioning whether that's enough or not. What are your thoughts?
I'd like to be more deployed.
Oh,
But my primary vehicle for being deployed in small cap resource names is private placements. And the private placement terms I'm being offered are despicable. Most private placements are going unfunded because most of the issuers have no value whatsoever. So whatever price they're able to attract capital at is overpriced. But the high quality overplacements are dramatically oversubscribed. I don't do private placements unless I either get a convertible preferred, shielding me from my downside, or I get a warrant, increasing my upside. And the opportunities to subscribe to private placements that I have seen in the last 18 months haven't attracted much capital from me. I'm already very deployed in the Franco-Nevadas of the world, in the Wheaton Precious of the world, in the Agnico Eagles of the world, in the Endeavors of the world. I don't need to increase my exposure to those names. I'm there. I'm pretty exposed to great developing deposits, the Lundin Minings, the Reunions, the G2s, the G Minings of the world. But where at other points in time, I would have been much more deployed in the higher quality juniors, I've been constrained by entry by the generally disadvantageous terms offered up to me in private placements.
okay. I noticed some basically opposite trends in other commodities. I'll pull this one up here. This is copper futures. And I think this might be what Lobo is getting at. So when we have the rate cutting cycle here for copper back in 89, copper lost 23, and then in 2000 it lost 10. In 2027 it lost 58, but then quickly shot up 250%, and then it lost 19 here. Is this what you suspect Lobo is kind of why he's holding out on copper and oil?
I think Lobo would suggest that the rate cut is happening because the economy is in worse shape than the market believes.
Okay.
Lobo believes, I talked to him today, that we will experience a recession that's sharper than people understand, and that we will experience it this calendar year. I don't have an opinion on that, Steve. I've told you before that Doug Casey and I have correctly predicted 17 of the last 3 recessions, so I don't listen to myself anymore. But if you look at the chart, I think that Lobo would say that copper has been selling off for the same reason that the Fed is considering cutting the interest rate, which is to say that the economic outlook is less good than people believe. I would ask your listeners to pay attention to their own economic analysis, not mine, not Lobo's.
Okay. All right. Fair enough. Okay. A member of the classroom brought up Cobalt. And then I created a post and got some more input and got a book recommendation from Todd, also a member of the classroom. It's called Volt Rich by Henry Sanderson. Have you read that book?
Yep.
Fascinating book, right?
It's a great book. I love to read. So when I say it's a great book, people who are less inclined to reading might not like it, but I found it very interesting. I found it stimulating. I'm not saying I agree with all the conclusions, but I certainly like being exposed to all the ideas.
Yeah, he goes into it reminded me of your electric and battery metals boot camp because he's got a whole section in there on batteries and lithium, cobalt, and nickel. My God, he talks about you've told us before about the risks that come with investing in Glencore, and I didn't truly understand what those risks were until I read that book. What are your thoughts on cobalt right now? When I look at the cobalt chart, I can't help but get excited because let me clean this up a little bit here. There we go. Take those out. Okay, so whenever something's at this end of the chart, I start to get excited as far as buying, and at this end of the chart, I start to contemplate selling. What do you see macro right now with cobalt?
Cobalt has wonderful utility. Uh, I remember many years ago talking to the head of procurement for Toyota. And the head of procurement for Toyota told me if, ironically, there was 3 times the supply, there would be 5 times the demand. He said that manufacturers are constrained in developing technologies employing cobalt because the supply is so uncertain. I had never thought before in a commodity that if you increase the supply, could increase the price. But he told me that he would be very willing to pay the double the then existing price for cobalt if he believed it would be available long enough to support a product cycle. There are so many utilities for cobalt as an alloy, not just in batteries. The thing that holds cobalt back is supply. It comes from Congo, to a lesser extent from South Africa, from Russia. It's a truly amazing material. It's very difficult to buy cobalt in the equities markets because if you buy cobalt, you're buying Congolese political risk or Russian political risk. Two things I've been confronted with most of my career. I have encouraged very strongly, so far to no avail, my former employer, Sprott, to start a Sprott Physical Cobalt Trust, even offering to give them a lead order. They have a battery metals trust, which is partly cobalt. But I think a pure play in cobalt would probably attract $300-400 million, which from Sprott's viewpoint would be profitable, and from my viewpoint would be attractive. I no longer, personally, want to go into the market and buy $1 million worth of cobalt and arrange for storage and arrange for insurance. I don't want to do that. I want a product that I can buy with a click of a mouse on the New York Stock Exchange, sell with a click of a mouse on the New York Stock Exchange, and I want young people to arrange for storage, sale, and insurance. So on the material itself, I'm very bullish in the longer term. I have no idea what's going to happen in the market for a year or 2 years. And frankly, Steve, I have no interest. It's odd that when I was young, I was very impatient and I wanted immediate gratification when I had lots of time left on Earth. Now I'm old. My time on Earth is more precious, but I've become more patient. Why is that? It's because I've learned over the course of 50 years of investing that most investment themes take 5 or 6 years to play out. I have no idea what's going to happen tomorrow. I have no idea what's going to happen in 2025. Neither does anybody else. One of the biggest problems in our sector is that investors buy into very long-term narratives. What's going to happen to copper supply? What's going to happen to the deterioration of purchasing power in the US dollar? What's going to happen to natural gas pricing? They buy into narratives that are 5 or 6 year narratives, and they employ 3-month strategies. How dumb is that? So with regards to cobalt, I feel great about cobalt. I feel good about cobalt in the 3-year term. I feel great about cobalt in the 10-year term. I have no opinion in the 3-month term.
Okay. Yeah, I did some research on this, not a whole lot, maybe 15 hours worth. And it looks like the DRC accounts for about 7 out of 10 pounds
Yep.
of cobalt coming out of the ground.
Yep.
Glencore pulls out about 1 out of every 4 pounds out of the ground, but it makes up a very small percentage of their revenues.
Yeah.
Is there, Glencore is worth 60 billion or something. Is there a company that's maybe worth like 200 or 300 million where Cobalt accounts for half of their revenue, where we could really leverage something over the next half a decade that you're aware of?
There very well maybe, but I don't know it.
Okay. Okay.
Yeah, I'll just leave it there. As you point out, Glencore is important to Cobalt, but Cobalt isn't important to Glencore.
Yeah.
China Rail and China Minmetal are the other big producers, and they're sort of no-go for American speculators. And also, cobalt for them is a byproduct of copper production.
Yeah. Yeah. Okay. I found the same thing. All righty. Let's move on to oil and gas. And I've been thinking about this a lot lately because we have Team Blue and Team Red coming up, coming in November, and just contemplating the possible outcomes for our oil and gas equities. What do you see as outcomes for our oil and gas equities with a Team Blue win versus a Team Red win?
Clearly, a Trump win would be better for the oil and gas industry. The idea that they can employ their capital and their technology with access to more land, with less impediment to transmission, would be a benefit. Two, both sides are transactional. And I think it's likely that Trump would be amenable to transactions that lowered regulation, lowered taxation in return for campaign contributions and votes, just like Harris would. She serves a different constituency. That constituency is more obviously anti-oil. I need to say that I don't think Team Red or Team Blue is good for the country either. I wouldn't vote for Tweedledum or Tweedledummer, and I consider them to be interchangeable. But in direct answer to the question, without editorial, a Trump win would be much more beneficial for the domestic oil and gas industry. The choice is similarly clear in Canada. There, the prime minister is overtly hostile to the best industry in Canada, to the extent that Prime Minister Trudeau were allowed to pursue other employment opportunities. I think you'd see an immediate and dramatic re-rate and rebound in the Canadian oil and gas industry. Whether or not that will happen is a very different question.
That one we can place our bets for Birchcliff and Pato. Hopefully,
Absolutely.
in October 2025, we can win on that one.
You could pick anything, frankly, that was legitimate in Canada. And if you had a Trudeau victory, a Trudeau loss, I think you would see that sector really, truly dramatically re-rate, and deservedly so.
Yeah. So getting back to the election, if Trump would, like you said, have decreased regulation, meaning that these oil companies could drill, baby, drill. They could start deploying some of this capital into growing their resources. That would suffer, wouldn't it, on their dividends and buybacks, because now they're putting that capital to work in exploration?
It wouldn't need to. If you take the U.S. industry as a whole, right now, they aren't reinvesting enough money to maintain sustaining capital. If they don't begin as a group, there are some, Exxon as an example, that are. If they don't reinvest sufficient capital for sustaining capital, their ability to produce oil at the current rates will begin to decline in 2 or 3 years, and their return to shareholders will suffer. Theoretically, and it's just theoretically, one can't do game analysis for other people, but theoretically, the ability to increase the net present value of your reserves at reasonable costs, which current conditions certainly offer up, should mean that equity prices would go up. The nervousness that professional oil and gas investors like myself have right now is that return to shareholders are coming at the expense of solvency, that they're giving me my own money back if they aren't making sufficient sustaining capital and new project investments to maintain the returns to shareholders, in effect, that the money that they're giving me back is mine. It's not surplus. It's cannibalism. And I tend to involve companies with high yields where that yield is cannibalistic.
Okay. Okay. All right. That makes sense. What are some uh, publications that we could, get to study oil and gas better?
That's a great question. I know a lot of people who manage $1 million portfolios and try not to pay for information, which is hardcore stupid. It's really hardcore stupid. People who are going to have at least $100,000 in the oil and gas sector need to buy two publications. One is the Oil and Gas Investor by Hart Publication. I'm sorry, by God, I forget the name of the publisher. Oh, Penwell Publications. I've been reading it since university. The Oil and Gas, Oil and Gas Journal is the name of the publication. Oil and Gas Journal. It's a technical journal, but somebody who pays attention can understand it, and it's a wonderful way to learn about new technology in oil and gas, everything in the oil and gas investor. The second is a more focused publication. It's called the Oil and Gas Investor, published by Chemical Week, by the Hart Publications division of Chemical Week. And it's absolutely invaluable for the retail oil and gas investor. It's not breezy like a newsletter. It is a publication that's really, really, really in depth. You have to work to read it. But the consequence of that is that the information is absolutely invaluable. As I say, anybody who has $100,000 or more in the oil and gas sector that's not in an index fund, that really wants to segregate the good from the bad from the ugly, should pay $1,000 a year, 1%, on information, and buy these two publications. Don't just buy them, read them.
Okay. Oil and Gas Journal and Oil and Gas Investor.
Correct.
Okay. And we're talking before about one, if you really want to cure insomnia, and we're probably talking to two people right now that are watching this, it is Decisional Analysis in Oil and Gas. That's the book that we alluded to months ago.
That is a very, very hard book. And if I alluded to it, I must have been hungover. It's a book that's been absolutely invaluable to me. But it is a book that requires a fondness for math, familiarity with engineering, and a familiarity with geology. Those aren't traits that I share with very many folks.
Okay. All right.
It has defeated at least one oil and gas analyst that I know.
All right. Sticking with oil and gas, my buddies and I were looking up bonds, and we came across Devon Energy's got some bonds right now that are just shy of 8%. Do you do any of these kind of bonds?
I love bonds. I don't like bonds that are selling above par, but bonds that are selling at par or below par, depending on the duration of the bond, I have a huge sense of humor for. I like yields of at least 7%. The reason I like that is, despite the fact that the CPI stated rate of inflation is 2.6, I personally believe that my purchasing power deteriorates at about 7.5% annually, which is to say, the basket of goods and services that I consume becomes 7.5% more expensive every year relative to my savings. I would prefer, if I'm going to lock money up for, say, 5 years and experience 7.5% compounded deterioration of my purchasing power, I would prefer to get a 250% real yield, which means I would prefer bonds with a 5-year duration that yield 10, not 7.5. Many of your listeners perhaps live different lives than me, or perhaps they haven't taken the time to understand the true nature of the deterioration of their purchasing power. And for them, a 7% yield may be superior. I personally would rather earn 5.6% with a 6-year duration than 7% with a 5-year duration. I would rather use a bond for liquidity if it wasn't actually preserving my capital. The idea that I buy $1 million worth of bonds, as an example, at 7% for 5 years, where the purchasing power of both my principal and my interest was declining at 7.5% compounded, means that I would allocate capital for 5 years with the sure and certain knowledge that I would lose some of it. And arithmetically, that's not attractive to me. There are people who believe that the purchasing power of their capital is only depreciating at 2.6% a year, and therefore believe that they're enjoying a 4.5 or 5% real yield. I'm not on that team.
Yeah. Okay. What time we got? Okay. Going back to the upcoming election, like you said, Tweedledee and Tweedledum, I'm looking at the policies that they're possibly implementing, and neither of which, well, both of which are really good for inflation. They just go about it in different ways.
Correct.
You've been very active on Twitter recently, which is a lot of fun. And a lot of what you are posting about is libertarian.
Right.
What go ahead and tell us about that and the basics of being a libertarian and your thoughts on the current landscape.
I think the world works better if relations between people are voluntary. I don't believe in the initiation of force or violence except in self-defense. And I think that government is violent. I see all sorts of comments on Twitter about corporate power and very little reflection on government power. I see Robert Reich referring to oligopolistic companies without acknowledging that the US government has a legal monopoly on extortion and fraud. And I think that's wrong. As I get older, I want to be involved in the educational process. And so what I do on Twitter, usually, is I take a policy statement from Trump or Harris or Reich, or my favorite, Governor Newsom from California, and I ask them politely, if sarcastically, about their policy statement. Mr. Reich has made a lot of comments recently about unions, and I'm in support of unions. And I asked Mr. Reich what he would feel about a taxpayers union. I feel that taxpayers are underrepresented and they're exploited. And I think that taxpayers should have a right to form a union and engage in collective bargaining with the government. I think if Mr. Reich believes in unions, that he should believe in the right to strike, including a taxpayer's right to strike. And I think that taxpayers, unlike any other exploited class in the economy, would love, in the event of a strike, to be replaced by management. So that's what I'm trying to do on Twitter. I very seldom make independent posts. What I do is I take on posts by policymakers. I address them as sir or madame because I don't want to offend their followers. And I attempt to analyze what they have advocated from the point of view of personal liberty, individual freedom, and the prosperity, the material prosperity of America. And I would suggest that most of them are antithetical to all those goals.
Yeah. How do you feel? Have you followed Chase Oliver?
I have. I have a sense of humor for the guy. Now, listen, somebody like me, a real libertarian who ultimately doesn't believe in politics, has no place in a party. You know, the idea that libertarians have a candidate, I think, has a lot to do with the fact that there's some group of libertarians who want to be professional libertarians. I'm not one of those. But I have a sense, I have a sense of humor for Chase. The last person I voted for, to be honest with you, was Harry Brown. And I voted for Harry Brown with a sure and certain knowledge he couldn't win. He was a good friend of mine. I didn't want to impose my will on others through the political process. But the idea that I could give Harry a campaign contribution and allow him to propagandize for liberty in the debates, which he did a sterling job of, and the ability to go into a ballot box and vote for a person I knew as well as Harry Browne and liked as much as Harry Browne was really, truly a once-in-a-lifetime opportunity. I haven't been able to vote for candidates since. I voted no on every spending resolution in the local elections, and I voted no on every resolution that I saw as being antithetical to individual liberty. But I haven't been able to vote for a candidate for years.
Yeah, yeah. Okay, let's wrap up here. Tier 1 deposits. We've got your boot camp coming up, which is on Tier 1 deposits, Saturday, October 19th. Now, you've said for as long as we've been talking that you focus on Tier 1 assets. How do you define a Tier 1 asset, and what is so important about Tier 1 assets that we're going to focus this next boot camp on it?
Big mines have big risks, but they make you big money. Small mines have big risks, but they make you small money. Big mines can come back from mistakes, and mistakes are inevitable. Small mines can't. So I like big mines. They don't need to be proven, but in the exploration phase, I like the hallmarks of a great big multi-generation mine, big enough to come back from mistakes, big enough that they'll still be producing when the commodity prices go up. Okay? I define a tier 1 deposit somewhat generously. I look for the probability of measured, indicated, and inferred reserves and resources exceeding $10 billion in value in situ at today's commodity prices. I don't let them organize the deck. I use today's commodity prices. And I want that deposit to exhibit enterprise value, which is market cap plus debt minus cash, that's less than 50% of the net present value of the deposit. In other words, I want to get the deposit cheaply because of the uncertainty. I want, in addition to the deposit having $10 billion in situ recoverable material, to be at least potentially in the bottom cost quartile in its commodity sector worldwide. And I want the deposit to be prospectively in the best return on capital employed quartile in its sector worldwide, but at least 25% return on capital employed. That's fairly rare. And to find one that meets all those criterion, which is to say a big deposit, an efficient deposit that's selling at half of net present value, almost invariably means that the deposit is in a country that people hate or a commodity that people hate. It is easy for me to talk about a platinum group metals deposit because people hate platinum group metals that I think will be tier 1. It's easy for me to talk about a rare earths deposit that I think will be tier 1. It's easy for me to talk about a graphite and rutile deposit that I think will be tier 1. They're all in countries that people don't like. There is also a gold deposit out there that I see that's potentially tier 1. I can't tell you ahead of time who the companies are that we're going to dissect at this tier 1 boot camp, but I can tell you that the faculty that we're going to have is going to be outstanding. I can tell you too that we're going to work your tushy off. That's a polite term. Over 8 hours. So this product isn't for somebody who's a tourist. This is for somebody who really wants to do a deep dive and for somebody who intends to apply the knowledge that they've learned in their portfolio. The course is probably best suited to people who have gone through the Rule Classroom, so they're prepared for the material that we're going to give you, because it's not a comic book. It's not light reading. The course will cost, I think, $99. If not, it's $95. I forget which it is. That's Albert's decision. And like every other educational product at the Rule Classroom, it's fully refundable. If you don't think you got your money's worth, we'll give you your money back. Now, there have been a couple people who've attended 3 or 4 of our sessions and asked for their money back every time. We've thanked and excused them from future offerings. But for most honest people, if for any reason you don't think you got your money's worth, even if you weren't well enough prepared to utilize all the material that we've given you, the financial risk is ours. Just don't come if you're a tourist.
Okay, well, I look forward to it. Like all your boot camps, they've been amazing for our brokerage accounts. Rick, thank you for coming back on the show. Any closing thoughts?
Just one. If you like what I have to say about natural resources, don't forget to go to ruleinvestmentmedia.com and list your natural resource stocks. I personally will rank them 1 to 10, no charge, no obligation. I'll comment on individual issues where I think my comments might have value, which precludes you asking me about crypto, tech stocks, or pot stocks. Don't do that. Finally, if for any reason at all you're unhappy with your current bank, I think that means all of you, check out battlebank.com. Or if not, in the question and comments section at Rule Investment Media, simply write in bank. And I'll send you information about Battle Bank, where we're battling for your business.
Awesome. Well, thank you very much. Thank you for tuning in. Join us over at the Rule Classroom and the Rule Classroom Plus, where we'll take your questions and ask Rick himself. And also check out the upcoming Tier 1 Boot Camp, Saturday, October 19th. Links are in the pinned comment below. Thank you for tuning in. Support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.